And certainly we're starting to see a bit of a mixed reaction here when it comes to risk, Ben, because you've got Asian markets still under a little bit of pressure, but then you've got US equity futures starting to rise. It really just plays into this thought. Is what we saw on Friday last week, we know there was low liquidity as well, but was it an overreaction, or is this the beginning of something really quite worrying?
Good morning. I think what happened on Friday was, at least in part, to do with positioning. And as you mentioned, it obviously being the Thanksgiving holiday, relatively low liquidity. So, of course, the shock is real. Omicron is something to worry about, of course. But I think that impact, it doesn't exist in a vacuum. It happened into a particular market setup. And I think what we're seeing now is some of the positions that perhaps were a bit busy have been cleared out to some degree, just because people are unwinding some of their positions in the face of this uncertainty. As I say, I think that's more to do with market positioning than the market taking a clear view on the variant itself, because I think, as we're all trying to be really clear on, there's still an awful lot we don't know about the Omicron variant.
Indeed, but does it complicate the picture then for the Fed too, given that we were looking towards this tapering?
I think so, yes. So we've got Powell and Yellen giving testimony to Congress tomorrow, our time, Tuesday. So we'll all be watching that very carefully. And I think Powell, it's quite likely, it seems to me, will remind markets of the Fed's new framework that they adopted in August of 2020. And the stress he's placed and other voting members have placed on the employment side of the equation, particularly diverse and inclusive growth leading to maximum employment. So I think any threats to that, and of course a particularly sinister, pernicious variant would be a huge threat to that, is something Powell and the Fed very obviously, I think, will have to talk to. So yes, I think there is some risk that some of the market-implied hikes will need to come out, but we'll get some more, I suppose, guidance from Fed Chair Powell as soon as tomorrow. And I think that is kind of a very important event in terms of what we can learn as to how the Fed is reacting to this.
Ben, can I get to our question of the day, which is all about how this variant may well affect markets long term, and a lot will be contingent on what you've just been talking about, perhaps what also Jay Powell says as well. Give us a sense of whether, I mean, it'll be far too early to be asking this question, but there is certainly a danger of a long-term impact.
So what I think is this reveals, again, structural fragility, not just, I was talking earlier a little bit about market positioning, but also in terms of policy direction. So for us at the BlackRock Investment Institute, there has been a policy revolution, critically in America, I guess, where the focus now is much broader, incorporating growth rather than a much more narrow focus on inflation. So I think this shock is further evidence in that direction, I guess, and probably what we're going to see over the next several hours, days, I think is evidence in that direction that Fed, in particular, policymakers more broadly, are going to be much more supportive for growth, employment, and frankly, broader social aims than has been the case maybe for the last 20 or 30 years. So I think that's a continuation of the same theme. Over the last several weeks, we've seen more concern about Fed relative hawkishness, and I think potentially some of that could come out over the next days and weeks as we are reminded that, if you will, policymakers are more fragile in the direction of growth. They are more focused on growth than they have been, perhaps in the US at least, for several decades, and that's kind of a huge deal.
Ben, I mean, it can lend itself also to what happens on the supply side of things, these supply disruptions that we've been seeing as well. But what really is happening here, market-wise, though, is showing us, and I think you alluded to it, the brittleness of the rally that we do see in some ways.
I think that's right. And the problem is there's no such thing as no risk, at least if one wants to be invested. So I would be concerned that if we have, which we do, by the way, negative real rates are likely to persist because inflation's a bit higher and interest rates are a bit lower, negative real rates are still rather supportive for real assets. So it's very, very strange, but potentially, and again, I just want to stress there's an awful lot we don't know about this variant. But in general, if we have negative real rates persisting, then structurally that should actually be supportive for real assets, critically including equities. So one needs to frame risk, I think, carefully. And part of that is staying invested, even through the trials and tribulations, scary though they can be, of incremental variants and so on.
Ben, you are modestly positive on China stocks, but just tell us a little bit more broadly about BlackRock's call here favouring China over what they're calling pricey India.
That's right. So China, we have a modest overweight in equities. We also like CGBs as well, by the way. But to focus on equities, it seems to us that you've had a kind of completely understandable huge decline in sentiment, positioning, and critically valuation. That's not enough in and of itself. But if it's also true, as we think at the BlackRock Investment Institute, that policy has flexed a little bit more pro-growth in China, then that combined is somewhat encouraging and leads us to, as we say, dipping our toes back into China equities with a small overweight position in Chinese equities.
Now, Ben, India's always been very expensive, historically speaking here. So, you know, is that a bit of a surprise for you, really?
The performance of India over the last several months and quarters has been amazing, frankly, right? It's just been very, very resilient to bad news, very responsive to good news, and long may that continue. But valuations now have changed and become a little bit less attractive, perhaps. And it's not so much a negative call on India, just we feel that there are better opportunities elsewhere in the region, I guess. And as mentioned, China seems to us to be critically flexing policy a little bit more growthy. That will only start to show up in the data with a lag. And to some degree, we're at the tricky bit at the moment where the data is not so good, reflecting where policy has been, not where it is. But as I say, we think given where valuations are currently in China, that combination of negative sentiment, valuation related, and growth policy flexing a little bit more pro-growth, we think is enough to see us dip our toes back into to Chinese equities.
And Ben, more broadly, quite neutral on EM. How do you kind of play this in terms of what we're seeing from central banks and also, of course, the potential knock-on effects from slower growth in China?
That's right. So look, I think EM, unfortunately, almost by definition, suffers disproportionately from shocks. It's kind of true by definition. So we've had a few shocks over the last year or two, of course, led by if led by is the right framing, but perhaps dominated by the virus, but now also the potential for somewhat more hawkish central banks globally. So for us, when we look around the world, we see better opportunities in European equities, recently upgraded Japan to neutral. So we're looking still for beneficiaries of where we think we can see the restart, because critically, even with the OMICRON news over the weekend and before, we still think that the restart is the right story. I guess we're big believers in the efficacy of vaccines and the ability for vaccines to adjust very fast and for new vaccines to be created in a matter of weeks, which should see if there is a delay, it will be a relatively slight delay and definitely not a derailment of the restart. So when we look around the world, we're still looking for economies that are geared into that activity restart and can benefit accordingly.
Ben, would you be interested in credit? Would you be interested in the corporate bond market in China? And I'm talking about not necessarily offshore, but onshore in particular, because it does seem that what we've been hearing and what we've been witnessing is a reluctance for the offshore creditors to get credited, I guess.
Yeah, that's right. It's been a little bit choppy, I think, in China high yield over the last 6 months and more. But I think when we started to see implied default rates in Chinese high yield up at kind of 45% around there, that seemed a little bit too high for us at the BlackRock Investment Institute. If that were to come to pass, we would be talking about a genuine systemic problem, I guess, for China, which it seems, to me at least, is something that authorities would rather avoid. So we've reached the slightly strange situation in China high yield where one can still assume relatively high, by historical standards, implied default rates and still be bullish. And of course, when we look around the world, yield is still very, very hard to come by, both nominal and real yields very, very low all over the world. So it seems to us that Asia high yield, Asia yield in general, is worth exploring. One, because it's a place, a geography that's actually got some yield that starts with a plus sign. And two, as I say, if we have seen policy flex a little bit more supportive, then maybe these implied default rates can come down somewhat, which can be a tailwind. By the way, not just for Chinese high yield directly, but for broader asset classes as well, because, of course, China very important for the region and indeed globally.